From pivot to crash, markets are having a field day with investors this week. Everybody was looking for a Fed pivot, pause, reversal, change because of what happened in the Bank of England, because of what's going on with the dollar, the bond market, things like that. The bond market's having the worst market in history and is wiping out the 60-40 portfolio, creating a lot of havoc in the markets. But stock market continues an orderly descending, unwinding pattern. So what the heck is going on? We had the jobs report come out today, and the jobs report continues to be strong. And what the markets are starting to realize and understand is the Fed is not going to pivot. They keep coming out with that narrative and warning the markets, we are not changing. We're not going to lower interest rates. We're going to continue hiking. If we get a hot inflation report next week, that's going to give the Fed even more ammunition to hike. So as long as they see a strong job market and entrenched inflation like we have, gas prices are going back up again, oil prices are going back up. The Fed has not made a dent yet, other than housing market starting to correct, but it hasn't really. Again, it's not a realistic correction because prices were so distorted, so in such a huge bubble because of these artificially low interest rates that even the price reductions and adjustments we're seeing now still haven't adjusted to what they should be seasonally and in normal conditions. Same thing with the new car market. I made a video the other day on a car lot. New cars are finally back in stock, but Americans might not be able to afford them. The prices are through the roof on cars because, again, easy credit. Lots of people had stimulus checks, subsidy checks, things like that. Interest rates were low and zero. And of course, with 7 and 8 year loans for new cars, it's ridiculous that you would finance a car for 7 or 8 years. I mean, it's getting to the point now to where cars are so expensive, they're going to finance them for 10 years next and then 20 years. And now you're talking about what you'd pay for a house or a commercial property or something like that. I mean, it just makes zero sense, the price of these vehicles and the cost that it's putting on people. Then when you add everything else that it costs to live, gas, energy, all the other things, inflation is a real problem. So the Fed has got to get that under control. They need car prices to correct. They need housing to correct. And they need all of these other entrenched inflationary costs that we've seen to correct. And what the job market's telling them is, 3.5%, the unemployment rate actually dropped. That's ammunition for the Fed. So the market is starting to realize that, price that in. And we have earning season coming up. So everybody likes to say everything is priced in. That none of that was priced in. Now the markets are starting to price it in. But we had a nice little relief rally in the interim. Here's Bitcoin finding support on the 2017 all-time high. It broke it below it. This was our major downtrend line where Bitcoin was coming to a potential decision point. There's a lot of open interest out there right now, record highs open interest. So that could create a big move. Hasn't created too big of a move here right now. Today, 5%, 4.5% move there on Bitcoin. Wrestling with this trend line. We'll have to wait and see if it'll close and then go back down and find resistance. And then again, test some of these previous lows in June, which Bitcoin has not tested yet. So that is the next breakdown that we're looking for. Bitcoin has kind of held this 2017 high, making people think that this is the bottom. And there's a lot of narratives out there saying the market will do exactly the opposite of whatever everybody expects. A lot of people are saying that, we're expecting that the majority of the market is expecting lower levels. I see it kind of 50-50. Half the people think that investors, analysts, everybody in the markets, half of them or plus or minus think that this is a bottom. Half of them think that there's another leg down and lower. Nobody knows for sure. And the global macroeconomic environment, traditional markets and all that are going to dictate where risk assets go and what level they go to, although Bitcoin has been holding up fairly well in this region. But traditional markets are as well. Here's something we haven't looked at in a while on Bitcoin, the hash ribbon buy signal that flashed back here on around the end of August timeframe, middle to end of August. And if you look at historically what's happened when that buy signal is flashed is typically price does not break below that previous low that was set once this signal flashes before it goes on another run. So are we going to see the price break back down and test that low? Because again, we haven't seen that before. The last time the signal flashed, Bitcoin went on that epic run after the July low. Of course, that was a different market condition, different climate. The Fed was still pumping, easing. Interest rates were still artificially low, and they got lower from there. Very different market environment there from a macro level. Same thing here back in November of 2020 with the buy signal. Same thing, back here around the pandemic level. And that's really the only time the buy signal flashed and it went down and took out the previous low after it flashed was the pandemic. And of course, that was an anomaly. So will it happen this time? Are the markets going to break down and take out that June low and negate the hash ribbon buy signal? The other thing that's happening, hash rate is at all-time highs because miners are investing and growing their infrastructure, increasing the strength of the hash rate. But that doesn't necessarily mean the value is going to go up. But the difficulty adjustment is going to happen on Monday, so that makes it even less profitable for miners. So that could put some pressure on some unprofitable miners. So we'll just have to see if they start to sell, what that ultimately does. And as we look at markets in general, the Dow's down 2.3, S&P down 3%, NASDAQ down almost 4%, giving up all of the gains that the markets put in over the last couple of days, pretty much. Still a little ways to go on the Dow. Almost there on the NASDAQ, and S&P flirting. Again, a little bit, 1 or 2% left to go to unwind all that. But the key thing is back below the June lows once again for traditional markets. So the question is, will that continue on? So we look at the dollar's rallying today, touch that trend line that we were looking at, continuing its march back up to see if it'll take out that 114 level. Oil is climbing with the announcement from OPEC. And of course, gas prices are up again and continuing to climb. We'll probably see, the average gas prices across the country over $4 again here before long, going into the midterms, going into election. These things obviously are not good for the incumbents. And, inflation, I'm hearing it from people out and about on the streets. The number one thing they're talking about is inflation and crime. Those are the two things that people are talking about more than anything else that they feel very insecure about and very uncertain about. So these are the things that weigh on people's minds during these cycles that we're in right now. And then of course you have the potential escalation on the war in Ukraine. And we'll just have to watch those things, which will, obviously drastically affect markets and things. But anyways, this is the cycle that we're in. We're in a quantitative tightening cycle, tightening of financial conditions. This is what the Fed wants. They have got to get inflation under control because it is beginning to become entrenched. The mindset of consumers in general, there's still a lot of consumer spending going on out there because people are still buying into the narrative that the inflation is transitory. The markets, investor fund managers and analysts and economists that have skin in the game are still talking about the Fed having to pivot, that the market's going to break, the Fed's going to have to turn course and change their actions. And as soon as anything like that, whisper of anything like that happens, you get those nice reactions in the markets, right? These traditional markets get these nice little bounces, 4 or 5% bounces. This was a big bounce here back off of those June lows, had that nice summer rally on the hopes of a Fed pivot. But the markets are trying to ignore the Fed and talk the Fed out of tightening, but the Fed's not having any of it. So next week's going to be a big week with data coming out, and especially the inflation print. So we will have to watch and see what that looks like. That will be the next indication of the resolve on the Fed. They're not meeting again until November. More and more, the odds are more and more of a 75 basis point rate hike again, because now the Fed has gone from inflation is transitory to inflation is entrenched, meaning it's not coming down no matter what they do, because consumers are still spending, which means they're ignoring it. They've got reserves, they've got savings. There's the coming off of COVID and things like that. People had saved up, weren't out spending, weren't out doing things. So now they're making up for that. We have the holidays coming, which obviously people spend more during the holidays and things like that. People traveled, all that kind of stuff. So all of those things are playing into the inflation environment that we're in right now. And the Fed has to stop that, because that, again, is going to do more damage than anything else. So very interesting times, very unprecedented times, things we've never seen before, with the bond market acting like it's acting, bonds being down along with stocks. Yields are up, but the price of bonds, the bond market's crashing along with stocks, the dollar rising, the housing market, serious demand destruction with inventory destruction at the same time, supply destruction and demand destruction. We've never seen that before. So these are very interesting, unprecedented, uncertain times, fascinating times. We have to continue to watch it. These are the things I'm looking at. I'll see you in the next video.